Carpenter Technology, ticker CRS, just reported Q4 2026 earnings. And we're sleeping the pleasantries today because they posted the most profitable year in their entire corporate history.
Yeah, the numbers here are just wild.
Right. So on the bottom line, it was a definitive beat. They reported EPS of $3.23, which easily cleared the consensus estimates that were sitting around $3 and $3 and $3.11.
And that's up, what, 46% year over year?
Exactly, up 46% from the $2.21 they posted this time last year. But then, we look at the top line, and they actually missed.
Which is always a red flag for some algorithms.
Yeah. Revenue came in at $851 million, missing estimates of roughly $863 million to $872 million, though, to be fair, it was still up 12.6% year over year.
And then management dropped their forward guidance.
Unbelievably aggressive guidance. Fiscal 2027 operating income is guided to $850 million to $880 million. That's a 21 to 25% increase. Plus, they threw out this massive fiscal 2029 target of $1.2 billion to $1.3 billion. So record profits, a bottom line beat, huge guidance. But how did the market react? The stock immediately dropped 5.1% to close at $503.71.
If we connect this to the bigger picture, you're looking at the classic dilemma of a momentum stock that's just, priced for absolute perfection.
Right.
Our mission for this deep dive is to dissect exactly why a stock with its most profitable year in history and massive aerospace tailwinds was sold off by the market. We're going to unpack their segment data, address a truly tragic leadership transition, and look at the valuation risks to figure out exactly what the market is pricing in.
Yeah, because when a company crushes earnings and raises long-term targets by hundreds of millions of dollars, and the stock still drops 5%, you have to dig into the operational drivers.
Absolutely.
So let's look at the engine of the company, which is their Specialty Alloys Operations segment. We'll just call it SAO. SAO brought in $229.7 million in operating income in Q4.
Which is a 38% jump year over year. I mean, that's huge.
It is, but the metric that's absolutely breaking financial models right now is their margin. SAO achieved a record-adjusted operating margin of 37.8%.
That is it's staggering for an industrial company.
Right, and to give you context, that's up from 35.6% sequentially and 30.5% a year ago. It marks their 18th consecutive quarter of margin expansion. And shipment volume rose 22%.
Yeah.
Okay, let's unpack this. A 37.8% margin for a specialty metals company. That sounds completely untethered from reality. I mean, is that structurally sustainable, or are they just temporarily squeezing blood from a stone during a cycle peak?
Well, it's an extraordinary number. A near 38% margin is something you'd expect from a software company, not a materials manufacturer running massive foundries and forging presses.
Right, melting metal is usually pretty capital intensive.
Exactly. But this isn't just a byproduct of a cyclical peak. It's a mix of productivity gains, highly favorable pricing, and an optimized product mix. They are capturing premium pricing for mission-critical materials.
We're talking about aerospace and medical, right?
Sure. Yeah, materials where failure is simply not an option. Think about it. Once an alloy is approved for a Boeing or Airbus engine platform, the engine manufacturer cannot easily switch to a cheaper competitor.
Oh, because of all the FAA certifications and testing.
Exactly. It creates an impenetrable moat. The airframers aren't price haggling over specialized titanium fasteners. Carpenter has secured this premium pricing power across both long-term and transactional business.
Which makes sense. I mean, if a fastener snaps at 30,000 feet, you've got a catastrophic failure. So they pay for perfection.
Spot on.
But wait, if they have all this pricing power and margins are exploding, why did they miss top-line revenue estimates?
What's fascinating here is how the raw material surcharges artificially distort that top-line number.
Okay, how so?
Well, that $851 million top line you mentioned, that includes surcharges. Carpenter passes directly to customers to cover the fluctuating costs of raw materials, like nickel or titanium.
Oh, I see.
If you exclude those surcharges, their actual net sales were $679.7 million. So the headline miss might just be noise related to those fluctuating surcharges.
Ah, so it operates almost like a toll booth. They collect the coal from the customer and hand it straight to the raw material supplier. It puffs up the revenue, but they don't keep a dime of it as profit.
That is the perfect analogy. The underlying core profitability is expanding rapidly regardless of that revenue miss.
Yeah.
And look at their cash flow.
Right. They generate a lot of cash.
Yeah. Fiscal 26 adjusted free cash flow was robust at $362.3 million.
Yeah.
And $155 million of that was just in Q4 alone.
Wow. So they are really minting cash.
Yep.
Which brings us to the future. I mean, to justify that massive FY 2029 target of $1.2 billion to $1.3 billion, Where's the growth coming from?
It's all about the end market demand.
Yeah, aerospace and defense sales were up 17% year over year. Demand is surging from engine manufacturers, structural suppliers, everyone.
You basically have to view this as a pure play on the massive aircraft backlogs sitting
Yeah.
over at Boeing and Airbus.
Because they're both trying to aggressively increase their build rates.
Exactly. They have thousands of backlogged orders, but you cannot assemble an airplane if you're missing specialized alloys for the turbines. Carpenter is positioned right at the center of that supply chain bottleneck.
Right. And to meet that demand, they're pouring capital into physical expansion. The report detailed a brownfield capacity expansion that is on schedule and on budget for early fiscal 2028.
And just to clarify for everyone, a brownfield expansion means they are building on existing, already permitted facilities, rather than starting from an empty plot of land.
Oh, which saves years of environmental permitting and zoning fights.
Exactly. Much lower risk. Management expects it to be operating income accretive by FY28, and it'll eventually contribute about $150 million in incremental operating income by FY30.
Plus, they're doing this while returning capital. They repurchased $179.1 million in stock in FY26, $45.2 million in Q4 alone, and paid $40.3 million in dividends.
It shows extreme confidence in their cash flow projections.
Here's where it gets really interesting, though, and honestly, incredibly tragic. Carpenter is undergoing this massive capacity expansion, but they just lost their new CEO.
Yeah.
Brian Malloy passed away on July 24th, literally just weeks after taking the role on July 1st. How does this impact execution risk?
Well, first, it's just a profound tragedy on a human level.
Absolutely.
But looking at it strictly through the lens of operational risk, it undoubtedly adds a severe layer of unexpected transition stress. The board reinstated former CEO Tony Thien as chairman and CEO.
So they went with a familiar face to steady the ship.
Right, and Thien is a veteran who orchestrated this current strategy. But the sudden tragedy hits during a critical multi-year growth and expansion phase. You need seamless execution right now.
Yeah, a billion-dollar scale-up requires intense focus. Relying on a returning veteran, even one as respected as him, feels like a temporary fix during a period where they can't afford any strategic overhang.
Which is exactly the friction point the market is digesting.
So what does this all mean? We have a strong backlog, massive margin expansion, a veteran CEO back at the helm. Why did the stock drop 5.1%?
This raises an important question about peak margins and concentration risk.
Let's talk about the valuation first. I mean, the PE ratio is sitting incredibly high. Depending on the metric, it's between 48.7x and 55.7x. Are we looking at a stock priced for perfection?
That's the bear thesis right there. Remember that SAO segment? It accounts for over 95% of their total operating income.
Wow, 95%. So they are overwhelmingly concentrated in aerospace and defense.
Exactly. Bears argue that a 37.8% margin is the absolute peak. You physically cannot squeeze more efficiency out of a melting furnace. If aerospace demand flinches or pricing power slips even slightly, those margins will compress hard.
So investors are wondering how much earnings power they should be willing to pay for at a 50-plus multiple.
Right. They sold off because the margin for error is zero.
And when you look at the smart money, the signals are completely fractured. Let's start with insider selling. Over the last 6 months, insiders executed 16 sales and 0 purchases.
Zero buys is always a tough look.
Yeah, James D. sold $6.19 million, and Marshall D. Aiken sold $5.21 million. People inside the building are taking chips off the table.
And the institutional funds are just as divided.
Yeah, Egerton Capital dumped 100% of their position, 1.33 million shares. But then Jennison Associates added 805,000 shares.
And you see the same violent split among analysts? BT upgraded the stock and raised their target to $620.
While Susquehanna and JP Morgan cut their targets to $600 and $700, it's a classic battleground stock. Nobody can agree if this is a multi-year supercycle or if we're standing at the absolute peak of the mountain.
Exactly.
So to synthesize this for you, Carpenter Technology is a fundamentally strong company. They're riding massive aerospace tailwinds with 18 quarters of expanding margins.
But, it requires flawless execution on its upcoming capacity expansions to justify a valuation that currently prices in near perfection.
Especially while managing the fallout of a tragic leadership transition. Which leaves us with a final provocative thought to mull over.
Yeah, let's hear it.
If the broader supply chain bottlenecks in the aerospace sector are finally resolved in the coming years, will Carpenter Technology lose the premium pricing power they currently command for immediate material availability?
That is the big unknown. Once the panic subsides, do those margins evaporate?
Exactly. Definitely something to keep an eye on. All right, that's it for today's deep dive. Make sure you hit the follow button so you never miss our daily earnings coverage. Catch you tomorrow.